This Crypto Trading MasterClass video course will consist of multiple videos which will take you all the way from explaining trading basics such as how the markets really work and trading terminology to advanced trading techniques that I also use every day for finding profitable trading setups. A new episode of this video course is roughly released every week, so make sure to subscribe to my channel and activate the alarm bell to be notified when a new episode is released. The goal of the course is to eventually bring you to a level where you can make your own crypto trading decisions with confidence and design your own trading strategies that are perfectly suited to your own style of approaching risk and reward. My name is Dirk and I've been a trader and investor for 26 years. Throughout my career, I had the pleasure to learn from some of the best people in the financial industry at banks, family offices, brokers and hedge funds. Since 2019, I am solely focused on trading my own account and helping new traders to faster reach a level of consistent profits and to not make all the same mistakes that I did until I reached this level. In this first video, I will cover some of the market basics. You will learn how prices are really determined on crypto exchanges, different order types such as maker and taker orders, what the funding rate is all about, and how to use leverage as a risk management tool. These fundamentals are very important because in order to later on design effective trading strategies, you need to know these things. For demonstration, I will be using a trading account on an exchange called Weex. If you want to follow along, you can find a link to the exchange in the description and pinned comment of this video. Let's say you want to buy or trade Bitcoin. You could of course ask your buddy that has been whining about buying Bitcoin to you for years already to sell you some, or go to some wallet service and directly buy there at hefty marked up prices. But eventually, especially if you intend to trade your Bitcoin to try to profit from its ups and downs, you will need to do so through an exchange. But once you click that buy button, how can you actually know which price you will purchase for, and how does the exchange know what the current price for buying and selling is? Good news is that if you use a good exchange, the price discovery process is very transparent and there is nobody like the CEO of an exchange just deciding what the price of Bitcoin is at any given moment in time. Let's have a look how it works by using one of the exchanges I personally use called Weex as an example. I have selected the trading pair Bitcoin versus US dollar TIFA here from the Futures Pro section. If you do not know what a future is yet, do not worry, we will get to that later. For now, we are just interested in how my buying and selling price is determined, because the way this works is always almost the same over all exchanges worldwide, no matter what asset class you are trading. To the right of the screen, you are seeing something called an order book with red numbers on the top, green numbers on the bottom, and a larger number in the middle. Notice that the numbers are changing really fast. This so-called order book represents an overview of all the buy and sell orders that customers of this exchange currently are trying to execute. Let's pause the video for a while and take a look at what's going on. The red numbers are sell orders and the green numbers are buy orders of clients. We can, for example, see that at the moment in time where we paused the video, somebody or a group of clients are trying to sell 792,970,000 US dollars worth of Bitcoin for the price of 56,427.3 US dollars per Bitcoin. On the other hand, there are currently clients trying to buy 56,427 US dollars worth of Bitcoin at the price of 56,427.2 US dollar. If at that precise moment in time we would decide we want to buy, let's say 1,000 US dollars worth of Bitcoin for the next available price, our buy order would be executed at the price of 56,427.3 US dollars per Bitcoin, because that is the lowest current price that somebody wants to sell for. The price of 56,427.3 US dollars would then also be the last price you would see on the chart, because it is the last price an order was executed for. See how at this moment this is currently the case for the last executed price, which was at $56,421.1 US. On the right side of the order book, you can also see how much money in total US dollars you would currently need to, for example, buy up all the sell orders from 56,427.3 to 56,429.5 US dollars. $3,950,000 US dollars in this case. Quite an amount of money to move the price by just $2.30, right? The difference between the best buy limit and sell limit is, by the way, the so-called spread, which in our example here is at 0.1 US dollars. The order book is highly dynamic and prices and orders can at times change within milliseconds. Notice how fast the buy and sell order prices change when I start playing the recording again. On the market tabs, we can also see in real time for what prices the last orders were executed. Notice how sometimes multiple orders per second are executed. I actually recorded this during a more quiet market phase, and even then it's almost impossible for the human eye to keep track. This order book approach of executing trades is actually very transparent and fair because it ensures that at any given moment in time, orders are executed where actual demand and supply meet each other. Some exchanges also cooperate with other exchanges to make their order books even more liquid and fair. You can see, for example, that in this case, the exchange I'm using, Weex, is also getting a price feed from exchanges called Huobi, Binance, and OKX. It is actually not very common for exchanges to be that transparent about where parts of their order books come from, and for me, one of the reasons that makes an exchange trustworthy. If you are currently working with an exchange that does not offer an order book, I suggest that you are extra careful, because this usually means that you are either working with an exchange that is so-called B-booking you, meaning that they take the opposite direction of your trade and thus win if you lose money, and or are trading an instrument called a CFD, contract for difference, which in my opinion comes with a whole array of downsides. However, more on the different instruments later on. Let's for now head back to our trading screen and talk about some more things we can see on it and that are important to understand. When opening a trade, we usually have several options to define how much of our order we want to have executed at which price. The two most important order types you need to know are the market and the limit order. Let's get back to our example where we wanted to buy 1,000 US dollars worth of Bitcoin. If we wanted to just buy this at the currently best available price from the order book, we would just choose a so-called market order. However, maybe we are also thinking that the actual price has already been going up for a while, and we are speculating on later on there being better prices available again at, for example, 55,000 US dollars. In that case, we need to enter a so-called limit order that tells the exchange that we want to buy 1,000 US dollars worth of Bitcoin at 55,000 US dollars and not for the current price. So you can use market orders to execute your trades immediately and limit orders if you first want to wait for lower prices to open a buy or long trade, or higher prices for a sell or short trade. Market orders are also so-called taker orders, as they take away liquidity from the order book. Limit orders are so-called maker orders, as they add liquidity to an order book. Because of that, you usually pay a higher transaction fee for market orders than for limit orders. If you are a very active trader that executes dozens of trades every day, it is often the better choice to use limit orders in order to save transaction fees. Another thing that often confuses new traders that start trading crypto futures is the so-called funding rate. A positive funding rate means that currently holders of long or buy positions have to pay an interest rate of 0.00933% every 8 hours to holders of short positions. A negative funding rate would mean that holders of short positions would need to pay holders of long positions. This is a mechanism to encourage that the price of a crypto future contract does not deviate too much from its spot price. The spot price is the price to which the underlying cryptocurrency, in our example Bitcoin, would be physically exchanged. Whereas when trading a Bitcoin futures contract, you would need to pay or receive a difference in US dollars between your position opening and closing price. Easy to remember. If you want to exchange some money for cryptocurrencies and just wish to hold on to them for a longer period of time, maybe even transferring them to a wallet outside of your exchange of choice, the better option is to use spot trading. If you are interested in trading and possibly also want to utilize leverage for your trading, crypto futures are the better option. A short word on the instrument of CFDs, contract for difference, that I mentioned earlier. Apart from some brokers out there offering crazy amounts of leverage of up to 1 to 1000 for these instruments, I do not think that these instruments nowadays offer any benefit over trading crypto futures. On the contrary, they often come with hefty overnight fees. A long trade where you use a leverage of 100 would, in this example, result in you being charged 4.58% of your position size every night. So if your position does not move quickly into your direction, this really becomes a problem for you very quickly. Let's continue the video by talking about leverage, which is one of the most misunderstood things and something especially beginner traders struggle with a lot in the beginning. Most crypto exchanges nowadays allow you to trade cryptocurrency futures with a leverage of up to 1 to 200. That means if you have an account with 1000 US dollars on it, you can open a position size of up to 200,000 US dollars with it. If the position then moves into the right direction, you can amplify your profits and earn a lot of money within a very short period of time. However, the pendulum, of course, can also go to the other side, and positions running against you will wipe your account out very quickly. In this example, a move of only 0.5% to the downside would already lead to a so-called margin call, where your current cash balance cannot cover losses anymore. I highly recommend to not use a leverage higher than 1 to 10 in the beginning. Normally, you can also choose if the leverage is calculated individually for every position, isolated mode, or across all your open positions, combined mode. I always use the combined mode to ensure that I always know what my total margin ratio across all of my positions is. In my opinion, leverage is a risk management tool. What do I mean by this? Well, imagine you have 100,000 US dollars which you want to use to trade. Instead of trusting a crypto exchange with all of your money, you could also just deposit 10,000 US dollars and trade them with a 1 to 10 leverage, so as if you were trading a 100,000 US dollars account. That way you at least with some of your funds protected in case the crypto exchange either goes bankrupt or even worse, runs away with your money. Yep, looking at you there, FTX. Alright, that wraps up the first episode of our Crypto Trading Masterclass. After now knowing about the basic terminology, how order books work and how to find your way around a trading platform, you have done the first important step to becoming a successful and profitable trader. In the next episode of the Masterclass, we will look at the different chart types, their pros and cons, and actually start to learn how we can analyze whether a cryptocurrency of our choice will go up or down. Remember to leave me a like and subscribe to the channel, and do not be afraid to request some topics for future episodes of Crypto Trading Masterclass that you wish me to talk about. Until we see each other again, happy investing.